I think one of the ideas that Munger helped Buffett and Buffett implemented, that rather than buy a cheap business at a throwaway price, you buy a good business at a fair price. And when he bought See's Candies, I think that kind of propelled his thinking that if you pay up for a business and you don't look at only at the earnings, but also look at its intangibles that they own, the value of the brand, the value of the moat, the value of the intellectual property, that will return manifold returns. And especially as we transit from a analog economy to a digital economy, sometimes analysts make the mistake of only looking at earnings and saying this stock is very expensive or this stock is very cheap, when they're not measuring the inherent moat that the business has, the inherent intellectual property that it has. So I think Warren Buffett taught us, for example, when he bought Coke as a franchise stock, the importance of the trademark. And he famously said that when he bought Coke, 10% of Coke for $1 billion, and someone said to him that if someone gave him $10 billion or $100 billion and said, replicate the Coke franchise, he would return the money back and say it can't be done. That's how much he valued Coke's intellectual property, trademark, global market share that Coke had. So I think, as investors, we all learn how to look beyond the P ratio that we are so fond of and look at the more intangibles in a business, and what is the moat in that business and how durable is the moat and the competitive advantage that the business enjoys.